Welcome to Stock Law Now. I'm your host, Scott Colasanti. Just a few weeks ago, for close to 5 hours, Congress grilled executives from Reddit and Robinhood on whether GameStop was or wasn't GameStopped. It was the most entertaining testimony since my cousin Vinny. And yet the best questions were never asked. And so now, coming to you from a corner of my garage where even the exterminator won't wander, it's Reddit and Robin and Bears, oh my! The spring's first podcast from Stock Law Now. As always, my trusty dog Cherry shall interrupt when I start to meander. And here we go.
Well, I do my best to understand, dear, but you still mystify, and I want to know why.
Dateline, December 9th, 2020. GameStop, a public company, sees its stock close at under $14 a share. 1 month later, a change in board membership and online commentary have pushed the stock price to over $31 a share. But a historical rise is still to come, as in late January, the Wall Street Bets forum on Reddit moves the stock price by 1,000%. To understand this bizarre turn of events, one need only focus on 4 dates. First, January 22nd. In response to tweet announcements of bear raids by hedge funds, countless members of Wall Street Bets triumphantly band together to buy the stock of GameStop and several other companies. In an unprecedented display of investor might, GameStop's share price rises to a peak $96 a share by January 25th. The next day, social media influencer and all-round fun guy Elon Musk joins the party by cryptically calling for a game stonk, which apparently means everybody keep on buying. The short sellers give up, and still the stock rises. GameStop incredibly opens at $350 a share on January 27th. Second key date, January 28th. Robinhood and TD Ameritrade announced purchase restrictions on the Reddit-touted stocks, foremost being GameStop. The stock price intraday jumps to $483 a share. But the GameStop joy is apparently over, and the stock closes that day at $112 a share. The Robinhood CEO later announces that volatility in the stock prompted margin calls from clearinghouses, monetary demand so dire that outside capital was infused into the firm. As for the hedge funds behind the failed short sales, one of the loss leaders required capital from none other than Steve Cohen, the owner of the New York Mets. Third key date for purposes of our analysis, January 29th. The long-awaited SEC response comes in the form of a brief written statement announcing that the Commission shall not be taking any action to either counter stock volatility or market restrictions. The SEC adds that it's keeping a close eye on things. Finally, the fourth key date, February 18th. A curious Congress has one of their best testimony parties ever. The initial speaker warned of rushing to enact new regulations and that there was wisdom to the crowd among today's investors. Nonetheless, for hours, the House Financial Services Committee accused individuals of unequal market participation and such ills as payment for order flow. In turn, these individuals, quite predictably, ran from responsibility for any harm. For example, a capital management firm CEO spoke of events that could not be anticipated. A trader named Roaring Kitty, who claimed to profit handsomely from the GameStop rise, testified that he was not a cat, or a hedge fund, or an advisor, just an individual who posted his research and analysis on social media. Meanwhile, the CEO of Reddit told the national legislature that the social media site is on some level overseen by an anti-evil team that watches the user-driven community. But nonetheless, content could appear sophomoric because it is directly managed by volunteers. Overall, as a stern committee chair scolded everyone who went over their 5-minute time limit or failed to answer yes or no to questions, investor, social network entrepreneur, brokerage house chief alike received a good tongue lashing during CNBC's primetime coverage.
It's the words that we don't say that scare me so.
Generally, the congressional inquiry was too disjointed to advance any one theory of blame. More specifically, the questions ranged from the pointed to the sublime. An impressively informed congressman asked why Robinhood allows so much margin credit to its customers. Sadly, Robinhood was later asked why the People's Broker wasn't a public company. Its CEO avoided a trap by not addressing the broker-dealer's rumored plans to go public later in the year. Overall, the toughest questions on market rules and operations were not sufficiently explored. In the ensuing month, the public, legal, and academic condemnation proliferated. The first class action lawsuit against Robinhood was filed by people who said they couldn't buy because of trading restrictions, and the New York Attorney General announced an investigation into those restrictions as well.
And I run in the rain till I'm breathless. When I'm breathless, I'll run till I drop. Hey!
This Rorschach test on the market served primarily to let people share their inner thoughts on what an equal playing field for universal investment profits should look like. But it all may be said to be moving too fast and too expediently. It's like trying to learn firearms from Yosemite Sam, or constitutional law from the My Pillow guy, or parallel parking from the Fast and Furious cast. Truth is, for 2 months now, the trend of linking volatility to the contemporaneous sins of social media and the nouveau riche has gained national attention. However, volatility is what markets are all about. Keep in mind that it's really only downward volatility that bothers us. That's why every stock exchange has triggers and curbs for falling prices, but none for skyrocketing prices. To start an inquisition based primarily upon a meteoric rise or attendant lost profits is a questionable motivation at best.
What goes up must come down.
And such a rush to judgment is likely to lead to the fruitless conclusion on a prior market debacle, the crisis of 2008. The congressional inquiry into that unfortunate time period yielded the pointless labeling events as a quote-unquote perfect storm. The media and possible defendants already have a name for the GameStop debacle, a quote-unquote black swan event. Yeesh. Once labeling something an inscrutable event of nature, nothing meaningful gets done. While we contemplate the potentially marginalized inquiry into a whirlpool of stock market events, actors, and legal issues, please enjoy this rockin' riff of epic crankage. Okay, enough epic crankage. Here's the thing. The word manipulation has been used far too often among fans of the sport of securities regulation. The violation itself comes from Securities Exchange Act Section 9A. That weighty measure has equally weighty requisites, including, among other things, the defendant's evil mental state and reliance by investors. But at their core, manipulation charges are tied to lies. As Congress said when adopting the provision in 1934, quote, "There cannot be honest markets without honest publicity. Manipulation and dishonest practices of the market thrive upon mystery and secrecy." End quote. Further, as the SEC explained in a 2017 case, the violation requires proof of, quote, "non-bona fide orders having no legitimate economic reason intended to inject into the market false information about supply and demand, entered for the purpose of moving the prices of the securities to artificial levels," end quote. Simply put, based upon what we know thus far, that ain't what happened with GameStop. People owned up to trading, on occasion sharing screenshots as proof. Some people announced a willingness to lose money to get back at the short sellers. So let's leave manipulation out of this for now. In terms of the most applicable and practical laws, here are 5 questions that need to be answered before we start sacrificing individuals at the Reddit Robinhood GameStop altar. Number 1, how do we accurately gauge this thing called short interest? which is said to indicate the amount of short selling haunting a particular stock. Time was that stock exchanges were formed to centralize information about securities. That rationale changed late last century when SEC regulation ATS allowed many broker-dealers to act as exchanges. In turn, to financially survive, exchanges now sell their market information. Indeed, the New York Stock Exchange stopped giving away computerized trading data and intra-month short sale statistics and now survives in significant part on the sale and purchase of such information. Moreover, it was private parties with hilariously funny names that reported between January 22nd and 26th that short interest had reached 140% of all outstanding GameStop shares. We can't rely on the private market for that. Just tell us, SEC, where do we go for accurate daily info on a stock's actual float? Second, assuming that the market's informal reports were accurate, how can the market sell over 100% of the shares of a company? We are now apparently living in a time of short sale counterfeiting. And the SEC already has a broad set of rules aimed at abusive short selling. It's called Reg Show. The problem is that the protections triggered by Reg Show only come into play upon the downward price spiral of a stock. GameStop and others experience perhaps a tragic price increase. Further, existing Rule 203 states that a broker-dealer may not accept a short sale order unless it has, quote, reasonable grounds to believe that the security can be borrowed so that it can be delivered on the date delivery is due, end quote. Simply put, the SEC's Reg Show rules need updating and better enforcement. Third question, do the rules of customer service and brokerage duty apply to all brokerages? The SEC's big change in 2020 was implementation of Regulation Best Interest, or Reg BI. Reg BI largely ties brokerage duty to trades recommended to a customer, thus theoretically excluding those brokerages serving only self-directed accounts. That compromise move so incensed state regulators as to prompt a lawsuit filed by New York, California, Delaware, and others to halt implementation of the new SEC rules. In part, those attorneys general feared a race to the bottom when brokerages are held accountable only for those trades they recommend. They were right.
He got the action, he got the motion. Oh yeah, the boy can play.
This isn't just idle speculation. The Robinhood CEO boasted to Congress that new investors can use something called Robinhood Instant or something similar to increase buying power for $5 a month. Surely, there are more costs involved in a margin account. If traditional rules apply to all brokerages, then margin is likely not being properly supervised or controlled or advertised. If Reg BI simply doesn't apply to the new app brokerages, then I guess we all need to just suck it up. Fourth question, can people taking advice on social media for their investments waive the protections of the securities laws? Numerous Reddit users shared that they were losing money by participating in the vigilante against short sellers and that they didn't care. But the Securities Act of 1933 and the ensuing Securities Exchange Act of 1934 both expressly protect the uninformed masses from waiving their protections against the wolves of Wall Street. But do we need our regulators to even regulate in a situation where investors are savvy enough to understand things like a short interest squeeze? Finally, number 5, what, if anything, contains after-hours trading? Why are not all stocks accessible thereon? Why are there fees? And are there any limits? Critics of Bitcoin note that the price swings wildly overnight. Well, the same could be said of GameStop, a registered public company, the share price for which jumped 140% overnight in after-hours trading post-January 26th. Additionally, one could reasonably ask, why the hell is billionaire Steve Cohen still a thing? In 2016, Cohen consented to a 2-year supervisory bar Indeed, it was part of a deal with the government that ensured he would not be personally charged with the violation or crime of insider trading. Although, of course, his firm and two of its lead traders were so charged. Cohen's firm paid close to $2 billion to end the government investigations. However, due to the limited terms of that deal, Cohen can now apparently do anything, including own a large stake of a hedge fund that is very much in the market. Come on, SEC, this guy always seems to show up when there's a bonfire. Plus, his Met team has consistently failed to develop young talent for over 40 years, for God's sake. All of which leads to this episode's soapbox. Imagine a world where people bought and sold only the stock they could afford, and where such stock actually existed in a definable place. Or where all brokerage houses followed one standard of care to customers/investors, and that standard was clearly communicated to everyone. Or where at least the SEC is invited to the congressional hearing on, SEC stuff. Because I tell you, stock law now says that many got away with a freebie in the past 2 months, including Congress. Here are some suggestions. For you, Robinhood, adopt the highest standard of care. You have millions of investors, many of whom are young and inexperienced. You told Congress that less than 10% of your customers use margin. That answer seems at best misleading. As a reminder, this podcast explained back in December that 100% of Robinhood's customer receivables in an amount totaling over $600 million comes from margin loans. And listen, Robinhood, with industry recognition comes change and costs. Hire lots of compliance personnel, because that marketing pitch of a selfless Sherwood Forest bandit redistributing wealth, well, its time has come and gone. As the five-man bobsled reminds us, there are limits to every good thing. And for you, the pandemic-inspired online trader, keep your boasts to yourself. The law may currently be centered on those who lie or fail to register as an investment advisor, but remember they got Capone on tax evasion. For the SEC, you, sir, remain the best and hardest working regulator in the free world. And the inaction to halt a bizarrely unprecedented trading bonanza is completely understandable. But this beast of social media trading needs some attention. More importantly, the question of what duty a brokerage house owes its customers is still wide open. Please don't spend 2 years investigating possible market manipulation on January 22nd, or any more time cautioning Elon Musk on his tweets. The man is what he is. Conversely, please do advise brokerage houses of every ilk that all customers are owed a duty of care, and that perennial rules on margin use, disclosures, and overtrading are still around and are still potent. And for you, Reddit, God bless you. We all got to watch live congressional testimony on a screen simultaneously featuring stock prices, news flashes, and best of all, actual posts from the disillusioned. And the mess you caused created the greatest law school essay hypothetical I've seen in 21 years of teaching. Reddit, you read my mind. The intersect of Main Street and Wall Street deserves a website. Just add sports clips and a red carpet runway, and I'm never turning off my 1997 Hewlett-Packard PC again. Well, that's all the time we have. As a tip for non-millennials, Downton Abbey in 3D is coming. Just imagine all the silverware jumping off the screen, and the Queen may come to dinner again. Well, Cherry, it's what I heard. I got a guy. I could have a guy.
Stock Law Now is prepared, delivered, and copyrighted by Professor Scott Colasante of Hofstra Law School. All views expressed herein are personal, so please, no wagering. For links to documents referenced herein, visit Castography at www.stocklawnow.com.